Hey everyone, welcome to this week's Nasdaq Dorsey Wright podcast. It is Thursday, March 2nd. It's going to be coming out Friday, March 3rd. My name is Will. I have Miles with me, a colleague, work friend, and just personal friend for a while now. He's one of the research analysts here, does a lot of the great work that you see in the report, read elsewhere. So we're going to be chatting about some things going on across the market as we do, and specifically spending some time on some of the recent GICS announcement and changes that are coming out. He's done some really cool work on that he wants to share. But before we do that, over the past week, I know we were sharing before we started, market really hasn't gone anywhere, at least like a headline index level. S&P is down about 1% along with the Nasdaq Composite and the Dow. So pretty flat in terms of absolute performance. Been decently choppy though.
Yeah, I mean, we really didn't see, too much action, really just rounding out a pretty lackluster February, I'd say.
Yeah.
But that kind of on some of the calls we've been speaking, we're at an inflection point, I'd say, in terms of, hey, we saw the S&P 500, move back into a negative trend a couple of weeks ago. We're kind of sitting kind of in the doldrums, I'd say, of what we're looking to do.
Yeah. And actually, I got a message from Jamie this morning talking about an inflection point. I know we're right around that 200-day moving average as well. March tends to be a lot better for the month or for the S&P in terms of seasonality. So yeah, definitely a bit of an inflection point. See if we can get something going. From a sector level, I also want to just mention when we get started for the past week, you saw actually a decent amount of dispersion over the past 7 days. Materials were up about 2.4%. And these are just the main spider cap weighted funds. And then utilities was down about 4.5%. And staples was down about 2.4%. So you saw a pretty good amount of sector dispersion, just not a lot of headline kind of major index action. I know you mentioned what were some of the earnings that were pretty big.
I mean, one that caught my eye was, of course, coming out through Lowe's. Of course, we saw Home Depot, and they tumbled after their earnings.
Right.
Lowe's was a big name to kind of watch as a discretionary barometer of where we stand. So a miss for them as well. They also moved back into a negative trend last time I checked. So big miss for both of them. Of course, not what we'd like to see.
Yeah. And I know Monster Beverage was another one within staples that I was mentioning on our call the other day. That one still looks decent, but decent amount of movement beneath the surface. Anyways, apart from that, I know we want to spend most of our time on the GICS stuff. You've done most of the legwork, so I'll let you explain for those that aren't familiar with the GICS jargon. What is that? And then how do we get to this point where we're going to make some more changes?
Yeah, so we're all pretty familiar right across the dolly screen or just in conversation with the GICS sectors, but we might not know what it stands for. It's the Global Industry and Classification Standard. So GICS breaks down any company into a bunch of different sub-industries, industry groups, and then, of course, the 11 broad sectors that we're all aware of. And those are annually taken a look at annually and updated to really, make sure that we're getting a good flavor of the different companies and making sure that they're all in different groups.
Mm-hmm.
And how are those groups calculated? Well, kind of the main portion of it is where these companies derive the portion of their revenue.
Yeah, I mean the MSCI site, they had a pretty good quote, right?
Yeah,
it was like a two-liner or something.
Yeah, they're classified both qualitatively and quantitatively, signed a single GICS classification at the sub-industry level, then working its way up to the broad sector level. So again, you get that revenue, where the revenue comes from. And then also an interesting point that caught my eye was you're not just taking a look at where the revenue comes from, but where the earnings and market perception comes from. So market perception, kind of an interesting subjective.
Got to be the qualitative one.
Yeah.
Yeah, market perception. That's interesting. I think maybe we can get into that a little bit later when we talk about specifically like staples, discretionary, some of the classifications there. And I know GICS changes are not uncommon. We're not like index strategists or, experienced index connoisseurs by any means in terms of classifications. At least we've built indices, but not necessarily the classifications of stocks going into certain indices. But I know back in, I remember, was it 2018? Yeah, 2018, renamed telecommunication services to just communication services. You saw a little bit of shakeup there. And then 2016, that was the creation of the real estate sector, I believe, as well. So those are like big headline changes.
Well, I mean, and the important thing is, I mean, this stuff is happening annually, right? These kind of reclassifications, but a lot of the stuff, and we might be able to put it on screen at this point, is happening kind of underneath the hood in the sub industries, in the industries themselves. Not too frequently do we get big shifts in the broad sector stuff. Again, Mike, you mentioned that's 2016 with the induction of the real estate group. That's 2018 with the revolutionary, induction of Google, Netflix, kind of into a whole communication services. So it doesn't happen too frequently when you see this, and kind of segmenting or segueing into where we're going. We're seeing kind of a revolutionary one coming up.
You think
in mid-March? Yeah, March 17th after close, we're going to see some reclassifications that I think are going to be pretty substantial.
Okay. Yeah. And the reason that we care as technical analysts would be that it's going to affect potential price movement. Not necessarily extrapolating from now, but it's saying that just how these baskets of stocks are going to behave could potentially change.
Right. And then seeing the way that stocks interact with the different sectors is also important. And that's kind of where the root of my study or our study kind of comes from, is taking a look. I know we mentioned earlier the kind of the qualitative factors that go into it. Our study is really looking only at the price driven factors between a company and their overarching sector.
Gotcha.
So before we go any further, actually just say what those changes are, the ones that we think are probably most important. Both Visa and Mastercard, currently infotech or technology, housed underneath that tech sector, are switching over into what many people say are long-awaited financials. So they're moving over into the financials group. Then you've got Target, which is shifting over into the staples group, consumer staples from consumer discretionary. And then you've got ADP, that's switching from the tech group over into the industrials group, among others, but those are the kind of the main highlights.
Okay. Yeah, that's pretty neat. I wonder how Cassidy, my wife, would think about Target becoming a staple. She would probably completely agree.
Yeah, I was about to say that goes with the market perception stuff, right? I mean, I'd say, hey, that's going to be
market perception. Yeah. How often does your wife go to Target?
Yeah, Target, as they call it.
Oh yeah, Target. Cool. So you had on the quantitative point some of the data behind those individual stocks. Pretty interesting finding. I actually have been gravitating more towards how they got classified, right?
Yeah. So what I did was I ran a rolling monthly 3-year correlation return. Now that sounds pretty intense, but
very
essentially what we're doing is we're just saying, hey, we're taking the monthly returns for the individual stocks. So monthly returns for Visa, Mastercard, Target, and ADP. And then we're going to compare or find the correlation between those monthly returns and compare them to the monthly returns from sector proxies, which in this case was just the spider funds.
Yeah.
So saying, hey, are we seeing these stocks move in a coordinated fashion with one fund or the next? And if we're seeing them, move in correlation with one fund over the other, maybe that's where they should be classified. Is that happening as a bit of justification for the move?
Yeah. And I know like correlations can become much tighter in down markets where everything correlates and everything gets sold off. But at least 2022 was a bit of that. But what you're finding, I'm seeing that you've actually like over time, not just in one instance, you've seen some of these start to drift.
Yeah. And so
any like standouts you want to mention?
I think the first one being that we can probably take a look at is going to be both Visa and Mastercard. Their charts look very similar, so we'll just focus on on Visa, for instance. Taking a look at it now, you see the blue line. That's Visa, or the correlation between Visa and the new fund, that being XLF.
Gotcha.
The kind of darker line there is between Visa and XLK. That's that tech fund. So you see here at the very beginning, this data goes back until 2011. So we're seeing there a correlation of 0.4 underneath the correlation between Visa and tech. So at the very beginning of the data point is Visa was more correlated with tech than it was financials. Then going through time, of course, you see kind of that relationship continue to develop. You had that pretty notable stem downwards out in 2016, where you were pretty highly correlated with technology there, of around 0.8 or so. But recently, over the last couple of years, since really 2020 or so, we've seen that kind of relationship drop off. Correlation between Visa and financials pick up a bit at the same time as that correlation between Visa and technology drop off. And actually, at the time of this recording, Visa is more correlated with financials than it is with tech. So acting more like a financial stock than a tech stock, which is what GICS is. What's that page is doing.
Gotcha. Cool. No, that's interesting. That chart pulled up, and the charts we're talking about, we'll put them on the YouTube page or on the YouTube channel video, whatever it's called. Sorry. And then also Miles is going to be having the main report piece on Monday, where all these images will be there with a lot of other commentary that you can see. So make sure to check out our report this upcoming Monday. That'll be the 6th. I was also just looking at Visa's point and figure chart because I was curious. I mean, talk about a stock that has pretty much gone almost nowhere for 2 years. Visa.
Yeah. Oh, yeah. That's the straight inside of it.
Yeah.
About a trading range.
Yeah. Talk about a trading range. 5 attribute stock. So not a ton to say negative technically about it, but extremely range bound.
Yeah, but you haven't seen it really string together consecutive buy signals too frequently. I mean, you had back in summer of 22 and then back in 21, summer of 21 or so as well.
Yeah.
We're putting together a couple signals here. You could probably argue that sell signal was constructive ultimately.
Yeah.
Bouncing back up off that and reaching the new highs. So we'll take a look.
Yeah. Yeah. So what else you got? You had Visa, XLF, and then what was another one? There was
so Mastercard and XLF. Then I think the most interesting one we'll save for last. That's the Target one.
Oh, my favorite.
But we can do ADP. ADP and XLI. And ADP and XLK. So again, we'll mention it. ADP is going into the industrial group. That's XLI. It's leaving the tech group. That's XLK. So pretty standard chart here. It started off more correlated to the industrial group. Dropped off a bit. Kind of actually to see the groups kind of moving in tandem, if you will, over time as you move across that chart. At least in ADP's correlation to each one of them, that is. But with where we stand right now, we've seen a bit of a dispersion there. XLI is more correlated, or excuse me, ADP is more correlated to XLI than we are for XLK. So again, 2 for 2 or 3 for 3 for the GICS sector rotating into.
At least it's like the current most recent correlation kind of behaving more like that sector. So that'll be interesting to see if it sticks, because looking at some of these in the past, they flip-flopped at times. So we'll see if it sticks that way. All right, last one, probably the one that we both want to talk about for qualitative and quantitative reasons. Yeah,
I mean, you see here Target, right? You've got your XLY, which is your discretionary, and your XLP, which is your staples. So taking a look, and we're seeing, hey, we're starting off with that, again, that blue line is starting all the way at the bottom. So again, Target was not too correlated, at least at the beginning of this study. That goes back to 2001. Target's not too correlated with XLY, or excuse me, XLP, the staples group. Yeah, imagine the staples group 20 years ago, and then Target's business line 20 years ago. Yeah. So go ahead. And then as you go through time, you can start to see, right, the kind of rise and fall, if you will, in correlation of Target. But where we stand ultimately right now is Target still is looking like a discretionary stock, right? We see that darker line continuing to kind of rank above or sit above, that is the light blue line. So, Target shifting over into the staples group, not acting as much as a discretionary stock is where it currently lies.
Yeah, that's interesting. And two, I know you have that really light gray line, which is XLP, XLY, like that's in the downtrend. So it's telling you that the correlation between staples and discretionary is on the decline, right? So they're becoming less correlated.
Right. But to put it in perspective, if you take a look at where that light gray line is to start, you are seeing a near zero. So almost no correlation in between the two groups.
Mhm.
So I'm sure this is a podcast.
Yeah.
It's a topic for a whole another day.
Yeah. And it
but-
looks like it'll top out at 0.8 anyways over the past 15 years.
Exactly. Yeah. But you're seeing, that gray line is really showing, hey, the two sectors are starting to kind of blend together a little bit. We are in a bit of a downtrend, but overall, so going back 20 years, the lines are blurring.
Yeah. And that opens up a more of a conversation that we probably aren't qualified to have the full thing of, but just conjecture. I mean, that's really interesting to think about what people consider to be staples. I mean, do you call Amazon a staple? Do you start to call all these other companies staples that people buy staple-ish or, very defensive, durable goods on them?
I mean, heck,
for instance,
you get Apple iPhone coming out, everybody buys that. Is that a staple? I mean,
it's going to be tough.
So there, I think, derives some of that market perception of it, and that's subjective.
Yeah.
So
yeah. So it'll be interesting to see how all of this plays out for sure. And again, I think the reason that we care is because some of those weightings are going to change in the broader market. Did we already hit that image?
No, we didn't. And if
that's a good one to end on too.
Yeah, no, it is. And one of those being, I think is direction you were heading in there, is that XLK, which is that technology fund. XLK, in the top like 5 weightings or so is both Mastercard and Visa. They're holding about 8 or 9% worth of the top holdings of XLK.
So I guess my point that I was getting is like tech's weight is coming down in the S&P 500 sector weightings, and then was it financials is picking up?
Yeah. Okay. So that's the chart that you want to look at. We can pull that up.
Found it.
Yeah. So like you mentioned, Infotech dropping its sector weightings within the broad S&P 500, dropping down. Still a leader, of course, right? Still over 22%, but not over 25% anymore. So it's gone from 25.7 to 22.5. So just over 3%. It's shedding. Of course, most of that, as we know and have discussed, that's going to financials. Financials moving from around 12% up to over 14.5%. So they're kind of solidifying themselves, kind of stepping into that top 3 with healthcare, financials, and tech. Then underneath the hood there, you see some tightening. I think is a good way to put it. Consumer discretionary is losing target, and of course that's moving over into staples, which is heading up to around 7.7% or so. I think the big thing here is if you look at consumer discretionary, consumer staples, industrials, right? All 3 of them, and also communication services, all 3 of them pretty close.
Pretty close, yeah.
Yeah. So you might see some as market action dictates, right? These are just the kind of the baseline, right? As market action dictates, you might see these kind of shift around a bit.
Yeah. I mean, I always love looking back at like the benchmark composition for sectors 30 years ago, 30, 40 years ago, compared to what it is now. So who knows what it'll look like in 30, 40 years going forward. And those weights I just noticed are as of December 30th. So not that you'd really see a huge change in 2 months of action, but note that as well. So unless you got anything else, I think that's the bulk of what we wanted to hit today.
Yeah, I think so.
Cool. Well, I appreciate it. I'll give one more plug. Check out the report coming out on Monday. We'll have some of these graphics in there. Miles did a nice job with that. Appreciate having you on the podcast as well.
Oh, yeah.
Everyone,
First of many.
First of many.
Yeah.
That's right. Thanks for listening, everybody. We'll be back with you next week.